Firstly, could I invite Michael Clausen and Jennifer Cole to the stage for the first part of the session. Our first speaker, Michael Clausen, is the Economic Counsellor for the US government. Michael began his assignment as Economic Counsellor at the US Embassy in Canberra in August 2025. He was previously Chargé d'Affaires and Deputy Chief of Mission at the US Embassy in Dublin, and since joining the State Department in 2002, he has served in a wide variety of positions, including spokesperson at the US Mission to the European Union, Director of the North Korea Unit in the Office of Korean Affairs, Deputy Chief of Staff at the Embassy in Kabul, and Watch Officer in the Department's 24/7 Operations Centre. Michael.
Good morning, and thank you for the opportunity to join you here in Perth. It really is a humbling experience to be here at Paydirt with so many leaders from government and industry and finance and research who are really shaping the future of the global minerals sector. What I'd like to do today is just start by taking a quick step backwards because all of you in this room are deeply immersed in the topic at hand. But that's not the case for everyone, and if I'm speaking frankly, or for most people. But in February, Marco Rubio convened a major conference, and it was his very first as Secretary of State. And it wasn't about a geographic issue or an abstract policy agenda, it was about critical minerals, and it brought together dozens of government representatives at the ministerial level. And I think that's extraordinary in its own right, and that's thanks largely to the hard work of the folks that are in this room today, bringing that important topic to the forefront. So it's not a state secret that the few relationships are more important to the future of strategic materials than the one between the United States and Australia. Our countries have long been security allies and economic partners, but over the last several years, our cooperation has taken on even greater strategic dimension, building resilient supply chains for critical minerals. These materials, as you all know, are foundational to modern industry. They support advanced manufacturing, aerospace systems, semiconductors, telecommunications infrastructure, and the defense technologies that underpin national security. Yet the global supply chains for many of these minerals remain highly concentrated. For decades, mining, processing, and refining capacity has become consolidated in a small number of jurisdictions. That concentration creates strategic vulnerabilities for industrial economies and for the defense industrial base. Addressing that challenge requires more than just new mines. It requires building integrated supply chains across trusted partners. And that's exactly what the United States and Australia are doing through our critical minerals framework that was signed in October. This framework has become one of the most important bilateral mineral partnerships and is being replicated now around the globe. It aligns investment tools, industrial policy, and regulatory coordination between our governments with a clear objective: to ensure that minerals produced by allied nations ultimately support allied industry. Over the past year, we have translated that framework into real projects, real financing, and measurable progress. Over half of the projects the United States and Australia have committed to support under the framework are based or have their headquarters here in Western Australia. They are providing the inputs necessary for our supply chains. One of the most significant developments has been the expansion of government-backed financing tools to accelerate critical minerals investment. The Export-Import Bank of the United States has played an especially important role. Over the past year, EXIM has issued multiple letters of interest supporting critical minerals projects across allied countries, including projects here, of course, in Australia. One of those LOIs went to Tronox, $400 million in support for the construction of a proposed cracking and leaching facility in Western Australia. These letters of intent are a signal to global capital markets. They demonstrate that the United States government is prepared to support large-scale investment in strategic mineral supply chains, particularly where those projects strengthen allied industrial capacity and diversify global supply. These commitments also provide project developers with something that has historically been difficult to obtain in the mining sector: long-term financing certainty at scale. And that certainty is helping unlock private investment. Another example of the progress our two countries are making together is the gallium recovery project being advanced by Alcoa, again, right here in WA. Gallium is a critical input for advanced semiconductors, radar systems, and a range of other high-performance electronics. But today, the global supply of gallium is highly concentrated. The work underway to recover gallium from alumina refining streams represents an important step diversifying supply within trusted industrial economies. It's also an excellent example of how innovation in existing industrial processes can unlock new sources of strategic materials. It is also a great example of the potential for trilateral cooperation because our Japanese partners are also deeply invested in that particular facility. Rather than relying solely on new mining activity, projects like this leverage existing industrial infrastructure to strengthen supply chains in a faster and more capital-efficient way. The United States views efforts like the Gallium project as exactly the kind of collaboration that our critical minerals partnership with Australia is designed to support. We've also seen major progress in rare earths refining and separation capacity. Projects led by Iluka Resources are helping establish large-scale rare earth refining capability within Australia itself. These facilities will play a crucial role in ensuring that materials mined in allied countries are processed within allied industrial systems rather than exported for processing elsewhere. Beyond individual projects, our governments have significantly strengthened coordination on project development and financing. Mining and processing projects require large capital investments, long development timelines, and regulatory certainty. Through our critical minerals framework, our governments are aligning financial tools, sharing geological and project development expertise, and working closely with industry to accelerate promising projects. This coordination reduces investment risk and helps move projects from feasibility to construction more quickly. Just as important, it sends a clear signal to global markets that the United States and Australia are committed to building long-term, integrated industrial partnerships around strategic materials. Institutional investors, industrial companies, and strategic partners are increasingly looking to projects across Australia and the United States because they know these projects are supported by stable policy frameworks and trusted government partnerships. But while the progress we have made is significant, we should also be clear-eyed about the work ahead. Demand for strategic materials is expected to grow substantially across sectors, and meeting that demand will require sustained investment in exploration, mining, processing, and refining. It will also require closer coordination among trusted partners. No single country can build these supply chains alone. But partnerships like the one between the United States and Australia demonstrate what is possible when resource economies and industrial economies work together. Australia brings extraordinary mineral resources and world-class mining expertise. The United States brings advanced industrial capabilities, deep capital markets, and technological innovation. Together, we are building supply chains that are not only more resilient, but also more aligned with the long-term economic and security interests of our nations. Looking ahead, the priorities for our partnership remain clear. We will continue expanding financial tools such as those provided by Exim to support major strategic mineral projects. We will continue encouraging innovation in mineral recovery and processing. We will continue supporting new refining and processing capacity within allied economies. And we will continue working with industry to build vertically integrated supply chains that connect mining, processing, and manufacturing across trusted partners. Australian mining companies, especially those here in Perth, are developing critical mineral projects in Africa, South America, and other parts of the world where we face geostrategic competition. We are working with Australia to ensure that these projects don't fall into the hands of our adversaries by strengthening existing authorities and diplomatic tools that review and deter critical minerals and rare earth asset sales on national security grounds. The United States and Australia have always stood together as allies. In the years ahead, our cooperation in critical minerals will become one of the central pillars of that alliance. Together, we are not simply developing resources. We are building the industrial foundation that will support economic security, technological leadership, and national defense for decades to come. And the progress we have already made over the past year shows that this partnership is delivering results. So thank you again for the opportunity to be here today, and I look forward to continuing this important work together.
Thanks very much, Michael. Our next speaker is Jennifer Cole. Minister Counsellor for the UK Government. Jennifer Cole, OBE, is Minister Counsellor National Security at the British High Commission in Canberra and leads work to strengthen cooperation on critical minerals as agreed by the two Prime Ministers. Jennifer has served in Islamabad, Washington, Tehran and at NATO and received an OBE for coordinating the UK response to international terrorist kidnaps. She was also Secretary to the UK Infected Blood Inquiry, the British equivalent of a Royal Commission. Welcome, Jennifer.
Thank you, and I'm delighted to join you. Unfortunately, I wasn't able to be here yesterday. I had to speak at an event in Canberra, but just before I was about to speak, the organiser said, "Can you sum up what you're going to say in less than 10 words?" So I rather like the challenge, and today, Think UK would be my summary. Now, I'm guessing... May I have the next slide? I'm guessing when you think UK, you may already know us as the centre of mining finance and expertise. The UK Export Finance Agency is the oldest in the world, founded in 1919. Our institutional investors have a lot of experience in the mining industry. May I have the next slide? But what you may not know us for so well is our domestic mining and recycling industry, right across the UK and already with Australian and indeed US partnership as well. So to just take one example out of that map, Rare Earths in Belfast took a spin out from research at Queen's University, Belfast, and is recycling rare earths magnets, and also has a project in South America. So a truly global enterprise to increase our resilience on rare earths. Have the next slide. In November, we published a critical minerals strategy, which sets out the UK government's agenda. And so we have 3 goals as a country. One is that we meet 10% of our demand for critical minerals by 2035 through our own mining. Second, that we meet 20% of our demand through recycling. So ionic rare earths are helping us with that. And thirdly, that by 2035, no more than 60% of any one critical mineral comes from one single country. So we have a lot of work to do, and Australia is a key partner for us in that. Next slide. So this sets out the critical minerals and the growth minerals and the support that is available for UK and indeed Australian companies who are contributing to this. And so that's where I come to my summary of Think UK, that if, as I've been talking, I've sparked ideas for you of, I wonder if the UK would be interested in, and I wonder if, then please come and talk to me. I'd be very interested to do so. As Michael said, this is a huge strategic drive behind what we're doing here, and some really exciting industrial and research and development collaboration across the whole sector. So thank you.
Thank you, Jennifer, and on behalf of the organisers, I'd just like to recognise the presence of 2 very senior trade officials from 2 very important partners for Australia, and so just thank them again as they leave the stage. Next in the session, we're going to hear from 3 other gentlemen. Can I welcome Luke Allum, Tim Buckley and Andrew Penkethman to the stage, please? There you go. I haven't seen Andrew arrive yet, but that's okay. Our first speaker is Luke Allum, Senior Analyst, third speaker, for Project Blue. Luke joined Project Blue in 2022 and was based in London as part of the cost team at Project Blue. He's now based in Perth. His work focuses on lithium and rare earths analysis, related consulting alongside assisting the wider cost team on model development. Welcome.
So today there's going to be some forward-looking statements, so take everything with a pinch of salt as such, but there won't be too much. There's going to be no price forecasting or anything like that today. So Project Blue, if you're not familiar, we're a critical minerals consultancy. We work with governments, we work with junior miners, we work with banks, and we cover about 30 different critical materials. And we're going to talk about rare earths today, and especially talk about the US and what they're doing in rare earths. But we're going to start with the China slide, because clearly the China dialogue is one that you've got to pretty quickly address before we get into the US story. They're pretty intrinsically linked. So where it clearly leads us is that China dominance dialogue that's been mentioned previously. The share of refined supply is pretty considerable alongside that first use supply as well, so that being embedded within products. And what causes that advantage? Well, it's really down to the foresight and policy. China's got the advantage of a political system that's prioritized and supported industry for multiple decades now. And actually, they've set themselves up as being a country that's very able to take mine supply globally. So mine supply is actually quite low, looking at things like, say, lithium, for a great example. And the Chinese market just is there to set up and take that material, take in that intellectual property, and really absorb all of that. So now we're sort of on a bit of an uphill battle trying to face that. Ex-China refiners have faced issues with flow sheets, and even Chinese refineries being set up still have those issues. So without that intellectual property, that gets really quite tricky. So that's a big challenge. So setting the scene, what catalyzed the US detachment from the Chinese market, or the, I suppose, plans for that detachment? It's all really been building momentum since 2020. Viable alternatives have started appearing in the rare earth market since about 2020, and there's been greater impacts to major domestic industries looking at sort of automotive, electronics, aerospace, and the emphasis and the leading dialogue from this started probably, if you look sort of late 2010s, early 2020s, that was sort of a clean energy space, and now that's moved into more of a defense sphere. So that's really unlocked a lot of funding for these things. And also China implemented greater controls on rare earths. So as previously shown, the China market dominates that flow of inward material, and Chinese state funding works to build and secure critical mineral supply globally. This really shapes the world in our view. You have areas with and without requirements for that Chinese state-funded infrastructure. So really the last regions that are without the need are Australia, Europe, and North America. But that does not mean that we're not intrinsically linked regardless. So remember this map, because this will be useful later. So looking into the export restrictions, I'm not going to go into too much detail on this. I'm sure people are familiar with it. If you're not, quickly take a photo, because it's quite a lot of detail. To keep it simple, all that's not restricted currently is lanthanum, cerium, and NdPr. So that's high level, the lights. The heavies have been heavily restricted. Announcement 61 was aimed at tightening down on restrictions that were on previous announcements, and this really targeted critical industries and prevented leakage of materials via transshipments. Then 62, that was a further building on that, and that really built it into things like technology, parts for manufacturing, and limiting people from providing assistance outside of China. So they're really trying to keep that IP held within country. So now what? We move to the plan. The US targets detachment by 2020 through these mechanisms. They're ambitious targets. Critics can call it a plan, a hope, a target, but there is being actioned, and there has been action for a while. The timeline looks a little bit like this. So hope, I guess, started back in sort of 2020 and was sort of shot down by the Senate, and everything went quite quiet for a little while. But in 2020 onwards, there's been a real sort of explosion of regulatory action, and then I suppose action becomes, plans become action in 2020 onwards, and really in Trump's second term. That's when we've moved from sort of a regulatory environment, sort of almost being like the Europeans of just regulating everything, talking about a lot of stuff. Now we've moved into some actual concrete action. So if we look at, this is the follow-on of that. So Trump's second term begins, you've got the Liberation Day tariffs, you've got the OBBBA, all this stuff has started to move. So this is the real action that we've seen in terms of timelines. And then if you look at this public funding, so if we look at public funding to projects, we see an absolute explosion of US-funded projects from 2025 to today. This map, as we remember the previous one, is almost the opposite of the previous map we saw in terms of areas of influence. So you're, again, seeing this world sort of split into two sides of spheres of influence, and this is really interesting. And this shows, I suppose, almost the detachment of globalization, that you've got, these spheres of influence building, and if we plotted the other Chinese map on top of this, they'd almost be opposite, which is quite fun. I think the key message on this slide, and one that I like to point out, is the pie chart at the bottom here. If you look at what's being funded, over half of these are multi-stage projects. And why is that? It's because if you just go and fund a mine, that is almost useless in terms of a supply chain. You've got this huge end-to-end supply chain for rare earths that's across mining, midstream, downstream, and if you just fund one, that sort of doesn't really fix the picture. So you're seeing a lot of M&A in the US, picking up bits and pieces and linking these things together, like ASM in Australia, their Korea plant sort of links into that whole story. So you've got this M&A sort of big load of material that's going along, and that's the idea is to sort of aggregate these things into end-to-end solutions, and that's how you get government funding. So looking at a few of these projects, we're going to go over this quite quickly. I've missed the most recent Serra Verde deal. Things are just moving too quickly at the moment. But that's where we were a few days ago. Action's being taken both in the US and globally. They're supporting domestic mining, refining, downstream magnets. But as clearly as Australian taxpayers know, putting money into something does not guarantee that success. So what is next? Once you've funded a load of stuff, what do you do to sort of guarantee that success even further? You sign MOUs with most of Asia Pacific. That's another way of sort of securing that material. So you put the feelers out and you say, okay, if we can secure as many partners as we can, that sort of guarantees our success in another way. So you support a load of people, but as a friend of Project Blue, Dave Abraham said, partnerships don't produce material. Going from narrative to production is the tricky part, and that's what the next few years bring us. And then you follow up the MOUs. What do you follow up this with? Project Vault. You look at building that strategic reserve. You've got 12 billion in funding, and you aim to gain a return on investment by securing material from various sources. So that's the next way you can produce some action. So what is the progress? The MP materials investment is broadly, it is working. The China feed has been cut off. Oxide production is, separation capacity is climbing. Processing elsewhere is optimistic, and lots of players are stepping in. So how does this affect things? You've got people stepping into that processing and separation. You can see that climbing quite significantly. So the progress, there's been lots of progress across various areas. I won't go into too much detail because we're slightly running out of time, and we'll talk about a few of the challenges. But lots of international agreements, lots of domestic and international collaboration being made. So the progress, again, this is on the heavies as well. So you can't just focus on NdPr, you need to focus on that heavies, and that's probably where the grand challenge lies. So looking at the domestic production, we'll just point out something that's quite key. If you look at the embedded NdPr in here, that percentage is dropping quite considerably. So that means that things are entering the US, not just as complete parts, there's more domestic capacity being built in terms of NdPr capacity, or NdFeB capacity. So, what are the challenges? Market pricing. No one knows what market pricing looks like. You get these PRAs that are talking about what the premiums are on material, and it sort of overlooks that some of those are very small trader-shipped margins that are maybe going to labs for very sort of high-use sectors. These sort of pricing isn't going to work for domestic downstream consumers. You'd end up with the most horrendously expensive industry in the world. So I think one thing to remember is when you hear about all these Western price premiums, they're pretty small margins. And if you look at the weighted average industry cost of these materials, it's pretty much the China price still. So I think any industry you build has to be competitive at China pricing, and that's the idea that you bring on this industrial base that can compete and that isn't sort of forever being propped up. So I suppose you've got to be careful as well with competition. What you don't want to be doing is competing with yourself. You've got Project Vault that's trying to secure material. You've got downstream consumers that are trying to consume material. You need to make sure that you're leveling out where demand is coming from. What you don't want is to bring on a load of demand because you're trying to stockpile, and that sends a bit of a false signal to the market. So it's really interesting on how sort of internal competition can really influence these markets. And I think an I do it myself approach has kind of been brought in. So a lot of people now are starting to think, okay, the focus is we'll just do it ourselves. We'll be the ones to lead this, but really a collaborative effort needs to be made. And yeah, as we say, stockpiling efforts from the EU, Australia, Japan, there needs to be coordination to stop this demand surge. So in summary, US are making some serious moves. The desire to produce material may come at the detriment of the material being internationally competitive, and that's where the real attention needs to be made, is that this is an industry that can compete on an international stage as well as a domestic stage, and I think there's a detachment from the China market, that's fine, but then it has to sit in the international. You've got partners in Asia, you've got partners in Australia, and they're all part of that picture. So I think that's the thing to remember. Yes, there is a detachment from the China market, but that doesn't mean we're splitting the market into maybe 6 pieces. It's all about that collaboration and those MOUs as we've seen before. Globally, a decision is needed on whether there is a split between that China sphere of influence, and I think some people outside of the US maybe find that decision more tricky. You look at European automakers, and they're very happy to sort of blow the trumpet on, oh yeah, we're following the US, we're supporting them, and then as soon as pricing goes lower, they go and happily support China again. So I think there needs to be some tough decisions made on where you sit in the world and where that sphere of influence lies. And I think people need to accept that either they're at the sort of detriment of China policy and how that looks, or they're supportive of a Western industry, and you can't really have it both. So it comes down to really the big question of what is the cost of security of supply? And that's the big question that everyone's got to answer. Thank you.
Thanks, Luke. That was one of the better breakdowns of the rare earth supply chain I've seen. Our next speaker is Tim Buckley, founder and director of Climate Energy Finance. Tim has 35 years financial markets experience, including providing public interest-related financial analysis on the energy transition since 2013, studying China, India and Australia. Tim founded Climate Energy Finance Australasia in 2022, having co-founded and worked with the global energy finance think tank IEEFA over the period 2013 to 2021. So for 17 years, Tim was Managing Director of Citigroup, Head of Australasian Equity Research, and Tim has published more than 100 reports on the global energy transition. Fantastic.
Good morning. I'm going to build a lot on what Luke has just talked about. I am going to provide my perspective and what I consider, I work in what I consider to be the national interest of Australia. And so the point Luke was talking about, do we want to have an anti-China strategy, or does Australia want to work with anyone that wants to work constructively with our country? So I'd reframe what you were saying. I think you were very clear and very detailed in your analysis. But Australia doesn't have a rare earth downstream industry, and we probably never will. China's invested 30 or 40 years building a downstream rare earth expertise and a global leadership and a capacity. They've invested in value-add global leadership, and now America's realised that China controls all those ace cards and America's pushing back. That's fine for America, but we are not America, we are Australia. We need to work in our national interest, and we need to recognise that China is our #1 trade partner. So for Australia to lead with an anti-China strategy, I think is a real own goal. I think we need to reframe it and say Australia will work with anyone that wants to work constructively with our country and value add in Australia and make sure there is value for our country using our resources. So you mentioned the four-way tag between Europe, America, Australia and China and Japan. I'd add Japan because they're a massive rare earth player and they're clearly having major trade issues with China. But Australia works really constructively with Japan. We work really constructively with Korea. We work constructively with Europe and America, and we work very constructively with China. All of those countries need what we have, so let's make sure it's constructive and that we get something out of it. I'll start by just stepping back. I work in a small, not-for-profit, public interest think tank premised on the fact that the world needs to accept and act on the energy transition, on the climate science. I accept and want action on the climate science. Secondly, I just wanted to put the framing. It's maybe outside of the prospect of this conference, but to me, the energy system transformation is happening, it's accelerating, and as Bloomberg New Energy Finance highlights, $2.3 trillion was invested in the energy system transformation last year. I'm from a finance background, follow the money, 2.3 trillion is a lot of money, and you can see, red, China dominates, and they've invested 4 decades in building global leading technology, manufacturing capacities, and they're also exporting it to the world. So to me, the climate science is real. We have to act on it. The cost of not acting is huge. It's rising, and we want to work with anyone that wants to act on alignment on the climate science. Again, look at the numbers, look at the money, look at the investment. This is Bloomberg's chart showing that China is building more wind, more solar, more batteries than the rest of the world combined. They're installing more wind, more solar, more batteries, more EVs than the rest of the world combined. They're exporting wind, solar, batteries, EVs more than the rest of the world combined. 60% of the world's solar installs last year in China, 60% of the world's wind installs in China, 80% of the world's offshore wind in China. So my point is, China is our #1 trade partner. We've got to be really careful about following America, because America's at trade war with China for very understandable reasons, but we need to protect and enhance Australia's national interest, not just follow America, because that's what we've done for 50 years. The energy system transformation absolutely happening at speed and scale. We heard yesterday, batteries, this is a critical minerals batteries forum. Batteries are booming. To me, batteries are the biggest single energy system disruptor in 2026, as they were in 2025. Batteries for behind-the-meter batteries. Australia is one of the world's largest installer of behind-the-meter batteries, 315,000 battery installs in just 10 months in Australia. But utility-scale batteries, Australia's the 3rd largest battery installer, utility-scale installer in the world in 2025 and again in 2026 and again likely in 2027. This is a version of the solar duck curve. This is California a month ago. The purple is transforming cheap, zero emissions, domestic solar from the middle of the day into the evening peak and eating the gas peakers dinner. That purple is a very serious number. It didn't exist 4 years ago. Now, what we're seeing in 2026, at the moment you can see that the duration of the purple is about 2 hours. In Australia, like in California, like in China, the duration of batteries is now 4 hours, not 2 hours. So that purple will double in size by going 4 hours every single night, because a battery can be charged and discharged every single day. And if it's Chinese battery, it'll last for 25 years. Doing that every single day. 4 hours means the purple in 2 years' time will be twice as big, because it'll be 4 hours duration, not 2 hours. I'd also argue it'll be higher because batteries are commercially viable. All of this is saying the world's energy system is transforming. Technology and manufacturing is absolutely driving that transformation, and you only have to look at the 20,000 R&D staff in CATL to realise how fast CATL, BYD and all the other Chinese manufacturers are moving. I think Australia's got a serious problem though. I want action to solve the energy system transformation, to act on the climate science, but we don't have a price on carbon in international trade. How do we, as a free market economy, value international trade? How do we do things like green iron or green aluminium or value add our resources if there's no price on carbon in international trade? Now, thanks to Europe, we've got the CBAM, the European and the UK CBAM. That is putting a price on embodied decarbonisation. So one of the things I advocate for is that we, Australia, advocate for an extension of the EU CBAM into the Asian market so that we have a price on carbon, we can become a renewable energy superpower, but be paid for it. Because if we're not paid for it, finance is not going to do anything. Public can throw a whole lot of government money at it, but you can't solve the problem if there's no price on carbon in international trade. I think we're going to get there. The trouble is, we will get there in 10 years' time when China's ready, will we have any industry in the next 10 years while we wait for China to get ready? Now, China is getting ready, don't get me wrong. I'm a bull on China and what they're doing. They are absolutely playing to win, as most countries do. And China is absolutely building the largest emissions trading scheme in the world. It's already 4 times Europe's by volume, but not by value, because China is a command and control economy. They don't have to worry about the price signal. When the price signal occurs, though, we've got to be ready. Getting to the point of today's talk and building on Luke's work, we put out a paper last month looking at, it's called Raw Power. China is going global. China has invested $220 billion. I've tracked transactions, about 300 transactions across the clean tech sector: wind, solar, battery manufacturing, EV manufacturing, cathode factories, anode factories. $220 billion since the start of 2023 says China is going global. They're trying to circumvent the trade war, both with America and with Europe, but also to build geopolitical alliances with countries that are not aligned with Europe and America. Think of the Global South, think of the BRICS, think of half the world's GDP is now in the Global South, and China is playing to win in those markets. So the first report is an extension which is saying $220 billion of value-added manufacturing investment by Chinese firms in Europe, in Africa, in ASEAN, in Latin America, in the Middle East, since the start of 2023. The new report we put out is saying that China plays very strategically. Do not underestimate how strategic, how long-term their thinking is. We identified over $120 billion of China going global in upstream mining. There becomes a strategic threat for Australia. So China, our #1 trade partner, is going upstream into mining and value add in Africa, in ASEAN, in the Middle East, and in Latin America in competition to Australia. Now, they're doing it for their own national interest, to protect their supply chains. In a world where there is a trade war between the 2 largest powers in the world, China is playing to protect its supply chains, understandably. But China plays by China rules, not by our rules, and certainly not by American rules. We've got to understand what they're doing, and we've got to actually respond with it. This chart just talks about where is the money going. Europe has actually been a massive beneficiary in, this is global battery materials in orange, and in blue, battery manufacturing. So you might be aware CATL is building a €4 billion battery manufacturing facility in partnership with Stellantis in Spain. But they're also building them in Hungary, in Germany, in Turkey. They're getting around tariff wars and tariff barriers by building within region to avoid those tariffs. They're also partnering to secure long-term geopolitical benefit. But they're doing it at massive speed and massive scale. What worries me is when I've put this, and this is all public information, I've put it on our website, you're available to have a look at it, have a look at the detail behind it. There's almost no Chinese value-add investment in our country. The last 3 years have been 3 of the lowest investments by China in Australia in the last 20 years. They're our #1 trade partner, and yet they're not welcome to invest in our country. Is that not a problem? Now, we can be a dig and ship, we can be a quarry to the world, and it's exceptionally profitable for BHP, for Rio, for Hancock, for Fortescue to dig and ship. We make exceptional profits on our iron ore. We make really good profits, the gas cartel makes really good profits on the exporting of our LNG. We get bugger all return on that. In iron ore, WA gets $10 billion a year royalties, as we heard from the mining minister yesterday. So the WA state, and hence everyone in a WA, gets a huge return on the iron ore exports. The federal government gets a huge return from corporate tax, from BHP, from Rio, from Fortescue, from Hancock. We get a great return on that. But we're getting no value add in our country. Again, when we think of China dominating these zero emissions industries of the future, this didn't happen because China's a communist state and China's playing a negative game. they're playing to build their manufacturing leadership. They're playing to build their robotics leadership. They're playing to build their technology leadership, and they're playing to build geopolitical alliances to reshape the world away from the Western-centric view of the last 100 years. All in their own national interest, all actually quite reasonable and understandable goals and objectives. But they also don't have the profit motive, the short-term profit motive. I come from the financial markets. I used to work in the biggest bank in the world for 17 years. I was managing director, head of research at Citi. Right? I come from a financial market. It's taken me 15 years to understand China doesn't play by our stock market rules. They don't give a toss about quarterly profits. They don't give a toss about annual profits. Getting them to worry about profitability on a decade view is a bit of an issue. Look at their solar industry. It's #1 in the world. It's 95% global market share, and yet they lost about $6 billion US dollars net loss last year. Do they think solar is a victory or a loss maker? The stock market would say it's a loss maker. The Chinese government says it's one of their most valuable industries. This is just, I've stolen it from BMI, Benchmark Minerals Intelligence. China has more than 100% of the world's cathode active material manufacturing capacity. Now, we heard yesterday about how China is, about how global demand for batteries is going to boom. It is. Global demand for EVs is going to boom. Yes, it is. Absolutely going to boom. A volume boom does not translate into profitable growth for Australian mining companies. China plays a long game. China's motivation is not profitability. It's about industry dominance. Now, as a Western country, we've got to be aware of that. China plays by China rules. China plays to win. They are winning. But when they've got more than 100% of the world's manufacturing capacity, bear in mind, what's their objective? It's the point I made yesterday. Does China want the price high or low? So maybe I disagree with Luke's conclusion that we need to get our costs down to China cost levels. We never will, but to Luke's other point, who gives a toss? Rare earths is a tiny industry. It's militarily critical, particularly for the Americans, particularly for Europe and for the Japanese. Not for us. We don't have any industry. It's not going to destroy our industry if China cuts our rare earth supply, and they won't because they need our iron ore. It'll hurt America, but that's between China and America, not Australia. So I'm not having an overt dig at America. I'm saying America needs to look after America's interests, and it will. Australia can help America. Australia can help the UK. Australia can help Japan. Australia can help China. We need to work with anyone that wants to work with us constructively. Don't underestimate the dominance. I'm probably out of time, but like, people go, oh, but China's going to be dependent on our rare earths for 30, 40, 50 years. Rubbish. China dominates recycling. Ask CATL why China dominates recycling. 80% of the world's recycling of batteries, because they recycle our rare earths and reuse them so that in 30 years' time, they're not going to need our rare earths, our virgin supply. China plays to protect its supply chains. So I won't go through these final couple of points, but I was thinking, what's the path forward? I want to see Australia value add our industry. So Indonesia is going to be talking later this morning. Indonesia has said countries are welcome, America and China are welcome to invest in Indonesia, but you've got to do some value add of their resources before you export them. Zimbabwe and Guinea have said the same thing to China. And China's response, fine, we'll build refineries in your country. Because China wants supply chain security. They've actually got a declining workforce. They're no longer worrying about the jobs. They're actually trying to get supply chain security. So Australia needs to actually stand up and say, if you want our rare earths, fine, but how about you do some value add in our country? So Japan's deal with Lynas is the ideal example, and it's an absolute replica, as Luke talked about, of the MP Materials deal that America did with America's MP Materials. Long-term volume offtake, fixed price, minimum price, profit sharing above $120. Don't play by China's rules and China's pricing, because if we do that, we will lose money. China's industry is 10 times, 100 times bigger than ours. Let's do it at a price that allows us an acceptable rate of return. Then investment will flow. So, to me, the Japanese deal with Linus is the perfect deal. It's stolen from a great idea from America and replicated in Australia's national interest. No overly disrespectful comment to our French colleague from yesterday, but the finesse lithium deal doesn't provide long-term offtake, it doesn't provide price guarantees, it provides a bit of debt. Where's the value add for Australia? It might help France get some supply of lithium, but doesn't help Australia. So, probably coming up time. So we've got to be careful. We've got to actually protect our relationship with China. We've got to work with America. This deal here, again, great for America, the Tronics deal. America gets all the value add. We just get to be a quarry. I did have to fact check when our colleague spoke. There is about 30% value add. We're doing a bit of leach processing of the rare earths before we ship it all to America, where they do all of the other value add. I want to see Australia more than a quarry. If Australian taxpayers are on the hook for $424 million, I'd like to see a little bit of value add in our country. Like, anyone can dig and shit from Australia. We're really good at that. We're world leaders at that. What we're not world leaders at is value adding. So if America wants our rare earths, brilliant. They can have as much of it, no problem. Sell it to them at a price that gives Australia some value add. Our lithium hydroxide is a really bad case study. We've tried to value add lithium. It's not worked. We say, oh, because we've got a high labour costs or we've got high energy costs. Well, why do we have high energy costs? America's got really low price gas. They're the world's #1 LNG exporter. Australia's the #3 exporter of LNG. We're really competitive, but we screw our own industry by charging them really expensive prices for domestic gas. We've actually got to play for Australia's national interest. I want those lithium hydroxide factories to work and to be viable, which means someone should come in and say, we want to diversify away from China. Let's think America or Europe or the UK. Come and buy as much lithium hydroxide as you want, but pay a price that allows us to be viable, and then it's a mutual win-win. Thank you. Sorry,
No, very, very good. Our next speaker who's joined us is Andrew Penkethman, who's Managing Director of Ardea Resources. Andrew is a resources sector executive and geologist with more than 30 years in the industry, covering exploration, discovery, feasibility study management, project development and operations within Australia and internationally. Andrew has been with Ardea Resources since 2019 and is leading the company and its subsidiary Kalgoorlie Nickel in the development of the Kalgoorlie Nickel project, the Goongarrie Hub. And I recall the precursors to both the company and the activities 20 years ago when I last lived in Kalgoorlie, Andrew, so I love to see material developments.
Thanks very much, and good morning to everyone, and thanks very much to the Paydirt team for putting on another excellent conference. I'll be providing you with an update today on the Kalgoorlie Nickel project and the progress being made. And just for context, the Kalgoorlie Nickel project, it is the largest nickel cobalt resource in Australia, so it is very much that large-scale strategic critical minerals project that we heard all about, the criticality and importance of in the previous presentation. Just the base case for us, we defined a 40-year ore reserve in our 2023 pre-feasibility study. Since then, we've formalised our incorporated joint venture with Sumitomo Metal Mining and Mitsubishi Corporation out of Japan, and because we're located here in Western Australia, we're all well and truly aware of the high standard of operations, whether that's health and safety and more general ESG and environmental stewardship. So Western Australia is every bit, in my opinion, the world's best operating jurisdiction, but we have to keep working together with all stakeholders to maintain that competitive advantage. So we'll be mining just north of Kalgoorlie. we'll be sending a mixed sulphide precipitate to Japan, where our Japanese partners have 75% of the offtake. They have the infrastructure, IP and expertise, and then the finished nickel products, whether that be for electric vehicles, energy storage, or traditional uses such as stainless steel, finds its way around the world to key partners. Just some of the recent advances from the Ardea team. We have been working with Export Finance Australia, who have been incredibly supportive, as have all of the federal government and state government agencies. And we've been able to work also with the US Export-Import Bank, and we've got indications for $1 billion of funding support for the Goongarrie Hub. Most recently, we're very pleased to see the collaboration between Japan and the United States and the Kalgoorlie Nickel Project referred to in their potential projects for collaboration. And most recently, with the Investor Front Door, an initiative from Federal Treasury here in Australia, there's only 4 companies being awarded that Investor Front Door status. We're working closely with Federal Treasury agencies to look at things like expediting permitting and approvals time and different funding options. So we're really excited to be part of this pilot program. Where's our project located? So the most advanced asset is what we call the Goongarrie Hub, and that's shown here in green, and that's the subject of our incorporated joint venture with Sumitomo and Mitsubishi. The other tenements in red, Ardea retains a 100% interest. You can see on this map direct access, road, rail, gas pipeline 40 kilometres to our east, fibre optic cable, and of course we're very close to the city of Kalgoorlie-Boulder and the Shire of Menzies, and we're very fortunate to enjoy terrific local stakeholder support. And I think that's one of the best things about our location. The local community know, understand, and are very supportive of the resources sector. A little bit about our incorporated joint venture. So our Japanese partners have recently earned a 35% interest in Kalgoorlie Nickel Proprietary Limited, which is the joint venture vehicle. Upon a final investment decision being made by our partners, they'll be awarded a further 15% interest to take them up to 50%. So everyone's very much focused, working with the KMPL team. A little bit of detail on our partners, and just in summary, Sumitomo Metal Mining, they've successfully developed and operate 2 nickel laterite projects in the Philippines, and they were the first company to get the technology exactly right and ramp up to full-scale production in under 12 months of operations. And Mitsubishi Corporation, they've got a very large presence around the world, and they've been supportive of resources project investments, both here in Australia for about 60 years and more broadly internationally for many, many decades. The technology being deployed is conventional high pressure acid leach. So we have autoclaves, the ore crushed and ground. It goes into solution in a very hot acidic sulfuric acid solution so that we can separate the ore-bearing minerals from the gangue or the waste rock. This technology's been around since the late 1960s and significantly de-risked, and we've seen HPAL projects implemented with great success in Indonesia over the last decade in particular, and we're looking forward to incorporating the latest technology that's largely off the shelf in our Goongarrie Hub project development. We've seen a lot of commentary about the nickel market, and it has been very challenging for the last 2 years, and that's mainly on the back of a large increase in production out of Indonesia. But since around December last year, we've seen the Indonesian government making significant moves to curtail and protect their national interests. It doesn't really help Indonesia if a lot of their mines are loss-making or break even, and then the Chinese, who dominate the nickel production out of Indonesia, getting that product for their industries both in country and around the world. So through mining practice, you're always going to target your highest value, lowest cost ore first. So they're depleting their resources is the first point. They're putting in place more stringent controls on the environment and permitting. For example, the mining permits used to be renewed every 3 years. That's been reduced to annually. And there's other mining and ore processing quotas. So we can see the increased management of their nickel resources and the corresponding increase in the nickel price. So late last year, the nickel price was about $14,000 to $15,000 a tonne. More recently, it's been in a range of about $17,000 to $18,500 a tonne, and it's Ardea's firm view that nickel market is going to continue to grow at a very strong rate. Indonesia can't provide all of the nickel the world needs, and that our timing to production is very well placed. So just in summarising, some of the key benefits, it's our location in the Eastern Goldfields of Western Australia. It's working with proven industry partners using established technology. They are fully funding our in progress definitive feasibility study with a budget of $98.5 million. And we're very pleased to see the support from both the local government, Shire Menzies, City Kalgoorlie-Boulder, and more broadly here in Western Australia, and the federal government as well. I've touched upon the support from these global export credit agencies, and there's a lot of additional interest from other ECAs around the world in this large-scale, long-life strategic project. Zoom in now on Goongarrie. So this is an image from our 2023 pre-feasibility study. The ore reserve blocks are shown in red, and that's the optimised open pits, and you can see immediately adjacent Goldfields Highway, the rail line, so the access to infrastructure second to none. All resources located on granted mining leases. Very long life mine defined of 40 years. We're looking to build upon this through the in progress definitive feasibility study. On average, about 30,000 tonnes of nickel and 2,000 tonnes of cobalt production. We're only assessing 6 of 9 mineral deposits, so there's lots of opportunity for the project to grow, and we've left space for a third autoclave in the process plant layout. So once that capital is sunk, the opportunities to expand production are there on a more cost competitive base because we can leverage off the infrastructure that will already be in place. Our operating costs, we saw in the previous presentation, it's very difficult to compete with China, particularly on the capital costs, particularly in developing jurisdictions, whether that be Africa or Indonesia. There's operating standards that we have here in Australia that I think we'd all agree are non-negotiable. Do they add to our cost of doing business? Yes, but that's why we lead the world in technology applications and the mining industry in particular. So we keep innovating to reduce our cost base and to remain globally competitive. But we've demonstrated from our 2023 PFS that we can be cost competitive with Indonesia and all global peers with the OPEX. So depending on the cobalt byproduct credit, our C1 operating costs are pegged to be anywhere between about $6,000 a tonne or up to $10,000 a tonne on a nickel-only basis. And we believe most of the Indonesian producers are in a range of about $6,000 to $18,000 a tonne. So you can see at our OPEX on the most conservative basis on nickel only at $10,000 a tonne, very cost competitive. Our process costs comprise the largest portion of our total OPEX, and we're very grateful to the federal government putting in place the production tax incentive. So what that means is we'll get a 10% rebate on our process operating costs. We've got a very large tenement portfolio, about 3,400 square kilometres now. A lot of that ground is prospective for other critical minerals. We've got over 6 million tonnes of defined nickel resources, but there's also nickel sulphide occurrences, modest gold deposit, occurrences of gallium, scandium and other critical minerals. So we feel with this strategic tenement portfolio, we've got the opportunity to continue to grow one step at a time, focus on developing Goongarrie, but longer term, we've got those options to continue to grow. In terms of the ESG, these photos all tell a great story. In our office, I'm commonly one of very few males. We don't have a gender diversity criteria that we strictly enforce. It's the best person for the job. Really proud of the team. We're a small team, but everyone works incredibly hard, and it's a credit to where we are today. We enjoy fantastic local stakeholder relationships. There's an image there to my colleagues. Francis and Rebecca attended the local playground opening ceremony at the Shire Menzies Primary School. That's one of many local Indigenous causes that we've supported since we opened up our Eastern Goldfields Education Grant Scheme. We're working on the flow sheet to minimise our CO2 emissions, and currently we're a fraction of the highest CO2 emitters out of Indonesia. So commonly their emissions are between about 50 and 90 kilograms of CO2 per kilogram of nickel produced. We demonstrated from our PFS that ours are about 12 kilos, so significantly lower, and we're working with the team on the DFS to maintain those low competitive CO2 emissions. So just in summarising, we've defined a globally significant mineral resource, and that's the subject of a detailed definitive feasibility study being fully funded by our Japanese partners. We're very fortunate to enjoy terrific stakeholder support, every level of government, and we can see that, as I mentioned, through initiatives such as the Investor Front Door, and we're really looking forward to accelerating our work with Federal Treasury and seeing how we can deliver on expediting approvals and other funding opportunities for the company. We demonstrated the Export Credit Agency support, and really urge you to keep an eye on the progress being made from the team, and welcome your time today and any questions post this event. Thanks very much.
Great project, and great to see the acknowledgement of how, particularly given the nature of our two keynote speakers today, how multi-government policy alignment helps strategic projects like this get up. And also in light of the panel that I'll welcome Editor of Paydirt, Dom, to introduce.
Thanks very much, Michael. I think, Tim, you're free to go.
I've taken one.
Well, but you're not off the hook completely. We'll see you again in the next panel. And I'll just call our other two panellists, Michael and Jennifer, to rejoin us on stage. What I particularly like about this panel lineup, apart from the great thinking that's going into it, is that everybody's already been introduced, so there's no need for me to go through biographies again, which I always seem to trip over and panic. As Michael said, I'm Dominic Piper, editor of Paydirt and Gold Mining Journal, and your moderator for this session. While we've heard their biographies, I'll just refresh everybody's memories about who the individuals are. Up on stage, we have Jennifer Cole and Luke Allum, Andrew Penkethman and Michael Clausen. Thank you very much, everybody, for joining us. My head is... we've got a whole host of questions that I'd already written, but after this morning's presentations, I've got a whole host of other questions rapidly running around my head, but I'm going to try and stick to our knitting to begin with, and dive into some of these, as we dive into some of these issues. Michael, I think you're the furthest, I was going to say furthest to the left, but given that we're talking politics, I think I shouldn't make those assessments. You're furthest away from me on the stage. I might start with you. It strikes me that down the years of both this conference and the US Embassy's involvement in it, and just generally in the sector, that various agencies and US government and policy regarding critical minerals and the supply chains for critical and battery minerals, it's had to go at every little area. You know, there's been incentives for end users, the consumers, there's been incentives for OEMs, there's been efforts to liberate the upstream potential and start by incentivizing the upstream potential, the downstream, the midstream. Is that a fair assessment in the first instance? And have the various agencies and the government and the industry itself found a sweet spot for the US in regards to critical minerals and where the most impact is both required and necessary?
That's a great question. I think the short answer is yes, although it is it's an iterative question, right? And it's something that is constantly being informed by our engagement with our partners. I think that, broadly speaking, I've served under 5 different administrations, both Republican and Democrat. And each administration brings their own unique style and priorities to an issue set. The one thing I always say about the current administration, the current Trump administration, is their sense of urgency and the sense of importance that they bring to this topic is incredibly interesting to watch. But the key thing there too is that in addition to this sense of urgency and importance, the other great thing that the Trump administration does is they connect Wall Street and industry to the policy agenda, which is something I don't think we've seen quite so dramatically in previous administrations. And by doing that, by bringing in a lot of this outside expertise, both from industry and from the financial perspective, I think that they are better able to identify the key areas to focus on as we approach this.
Thanks, Michael. Jennifer, a similar question. Really, the UK has the longest industrial industry and chemical industry and chemical manufacturing and other manufacturing, but it feels like it's not as relevant a player on that international stage. Is this awakening about the need to have a critical minerals perspective and a role to play on that global stage? Has it taken some time for successive governments to find where that space is? And is it, as Michael says, an iterative process still?
Yeah, definitely iterative, spot on. So having published the strategy in November, we're now putting together a demand aggregation platform, because that is one of the commercial challenges that, for instance, on defence, mission critical, but in peacetime, quite a small demand out of the total UK demand. So having aggregated it makes it much easier to connect with suppliers. So that will primarily be in the largest consumer areas, so defence and space, automotive and energy, but also potentially areas like quantum data centres and medical tech. So yeah, spot on, iterative.
And is there an assumption? There was an assumption maybe 5 years ago, again at this conference, that countries wanted to go it alone, whether it's Australia or the US or the UK or Europe or Japan or China for that matter, that they would be active in every link in that supply chain. Has the UK decided that it can't fill every link in that supply chain?
Absolutely. And whereas some partners like Japan have state organisations, like their organisation that worked with Alcoa to long-term investment, the UK doesn't have such an organisation, but we do have the city and the experience there. So I think each country brings something different, and for many of these projects, it will be multiple countries.
Thank you. Luke, a fascinating presentation this morning. And I know your research goes far beyond just rare earths, but it struck me in watching your presentation, you talked about a number of deals, and we'll get to Andrew's own deal in a moment, but it strikes me it's very difficult for governments, isn't it? Because mining projects are inherently risky. Not many get to the finish line or the development line. is it difficult for governments to inject themselves into this high-risk space and be able to pick winners at the same time as also being able to lift up those projects that traditional capital markets can't serve?
Yeah, and I think that's what you pointed on is quite accurately the role. It's there to de-risk projects. It's not there to fully support projects through their entire life. We're not in the deal of, I suppose, bringing back sort of Soviet-era economics of supporting mines throughout their entire life thing. It's all about sort of, I suppose, tilting the field in favour of a globalised, like a sort of globally competitive market, but it's not there to fully support an industry and pick winners as such. It's to, I suppose, pick a few national champions and almost let almost like portfolio theory come to it, of like you're sort of hedging across different technologies. Maybe you're supporting, say, the battery supply chain. You're supporting some guys on that are following lithium ion. You're following sodium ion. You're sort of hedging those bets in sort of, yeah, as like a portfolio you would individually. So I think that's the idea, that you sort of, slightly tilt the field in favour of these projects to get them de-risked, and then hopefully the private markets can take over and support them through the rest of the life of mine. Because you don't really particularly want to be supporting a project for the entirety. It's just getting it up and running and sort of taking that initial risk out, I think, is probably the government role and where they should sit.
Yeah, it's interesting. I'm just reading a book at the moment on the history of the UK in the 1960s and 70s, and obviously there was a trap that was fallen into there with certain state industries, as particularly companies like British Leyland, the car manufacturer, where millions and millions were sunk into a failing company and a failing industry. We're trying to avoid those traps today, and I think for governments it would be, the headlines would be very harsh for any government that chases that sort of situation. Andrew, you, the pressure's all on you then, because you, as a winner that's been picked by 3 or 4 different countries, really, you have an agreement with 2 Japanese corporations who work very closely with the Japanese government, and you have funding, debt funding with both the US government export bank and Australian export bank. As Michael said, it's a multilateral funding arrangement, but each of those countries has different approaches, different priorities. Does that make it difficult for a company like Ardea to be able to move along in the same time frame that everybody's expecting?
I guess if we go back a step, it's always been a challenge for any small company having a very large asset. And as I touched upon, the Kalgoorlie Nickel Project, it is the largest nickel cobalt resource in Australia. It's in the global top 10, so it's every bit that mega project, key global strategic asset. But Ardea is a small company, and we recognised some time ago we couldn't be held hostage by market sentiment and changes in commodity price. And as I touched upon during the presentation, it's been really challenging. We can't control the nickel price and the nickel market sentiment, but when we had many nickel producers in Australia either go into voluntary administration or care and maintenance, there's been that prevailing sentiment that there is no future for the Australian nickel sector. And the pinnacle of that was when our largest nickel producer, BHP Nickel West, was placed in the care and maintenance. So with that backdrop, we've tried to continue to advance the project as best we can, and we've recognised that we need strong stakeholder support, in particular local government, then more broadly state and federal government, and of course we're very happy to be collaborating with Japanese industry and more broadly the Japanese government, and there's some representatives here today, and we think we have to have that collaboration and we have to find a way through. Like we all know from everyday life, no one agrees on everything 100% of the time, but it's being able to get past those differences, continue to work together, keep your eye on the prize that is in everyone's best interests. And, using the Goongarrie Hub as an example, well, I personally feel, why can't it be every bit that collaboration between Australia? We've got the resources, the mining expertise, we produce midstream products such as MSP, because there is no downstream process options in Australia at this point in time. Japan has that infrastructure and expertise. Our partners have 75% of the offtake, but then that product goes to key ally nations such as the United States, such as the UK. So I think it's a recipe for success, is my personal view, and time will tell. But I feel we're making progress in what has been a very challenging nickel market, but that support from multiple government agencies around the world we think is incredibly positive and indicative of that push for supply chain security and diversity. So Australia's got some of the largest nickel resources in the world, but we've got to get new resources back into production, and we've got to work together to make sure we can be as cost competitive as possible.
Thanks, Michael. I think you're furiously taking notes there. What have you made of a project structure, a finance structure like Ardea? Is that the sort of, you mentioned a lot about allied minerals for allied manufacturing and industry. Is that the sort of deal that you can see continuing, where multilateral agencies from multiple jurisdictions are coming together to form a consortium, essentially?
Look, it's really dangerous to get into prognostication or hypotheticals, but I will, and I think that is probably the way things are headed. We don't have, I would just say, sort of broadly speaking, we don't have the option to make narrow selections. It needs to be sort of everything, everywhere, all at once, just like the movie said. But I think that this idea of cooperative action amongst government agencies, whether that's internally, for instance, in the US, I think another thing I've observed lately is there's far more interagency coordination in funding mechanisms, or if we're talking about bilaterally or multilaterally, for instance, I mean, the coordination between EXIM and EFA is extraordinary. I think they're on weekly calls to talk through different potential deals. And so I think that coordination and those coordination mechanisms really are where things are moving in the future.
Thank you. Luke, I want to come back to you, and we did have a question here already. I think Tim's presentation has brought into even sharper relief. Is this idea of supply chain resilience an achievable goal, or is it going to take multilateral, multi-jurisdictional structures to be able to deliver what most of these countries are looking for?
I think supply chain resilience is interesting because it depends how you're phrasing that. Is it you're going for complete self-sufficiency, or are you going for a more diversified supply base? So I suppose resilience I think a sensible way to view resilience would be having a diversified supply base, building strategic reserves. I think that gives you that resilience base that you can weather shocks, you can weather markets. But I think what a resilient supply chain needs, I think this is one thing that governments are probably taking more action on now, is trying to work out what demand looks like. Because there's so much uncertainty on demand that no one knows if batteries are going to be lots of nickel, or if they're going to be sodium ion, or what this battery is going to look like. So I think industry needs to be very clear and very transparent with the government of what their needs are in terms of material. And I think then also industry needs to be clear of, okay, if that material is getting supported, we're going to take that material, we're not going to take material from elsewhere. And things like the CBAM in Europe and things, that sort of incentivizes Western material more so. So I think you need two things. You need the demand signalling, then you need governments to step in and maybe secure that or de-risk those projects, and then also you need to then actually take that material and not say, oh, it's great you've done it for us, but we're going to go to the cheap supplier where that sits. So I think supply chain resilience can come from a few different angles, but I think complete self-sufficiency is unrealistic and would be quite not the best idea to shoot for, but I think you just need to be resilient of broad-ranging supply, I suppose, is best.
Yeah, Andrew, it's an interesting point, and I know it's one we've talked about on a number of occasions. The West Australian industry across nickel, across lithium, across a whole host of commodities has sort of lived in hope of a green premium being paid. But is that understanding shifting slightly and looking to have a resilience premium or a security premium, in that a project like the KMP can deliver consistent nickel and cobalt production for decades rather than be switched on and switched off or be unreliable or be subject to changes in policy?
I think if we start by looking at China and how they've got themselves into the commanding position they are in with critical mineral supply chains, a lot of it comes down to patient capital, enabling capital. And as I touched upon in my presentation, I don't feel we can always be cost competitive with the CapEx depending on the jurisdiction you're developing a project in. You know, they're different, you know, for example, in Australia, there's occupational health and safety and environmental guidelines we all accept as being essential and non-negotiable, but they will likely add to the capital cost. However, if we can be cost competitive on the OPEX, or as cost competitive as possible, and people are focused on that supply chain diversity and security, the capital will be there, and we're seeing that increasingly through this, you know, global collaboration and increased focus on supply chain resilience. So, you know, personally, I think it's very positive. You know, none of us can be completely dependent on any one provider, and we've seen those supply chain shocks, whether it be through COVID or more recently with some of the conflict taking place, whether it be in Ukraine or the Middle East. But yeah, we need that coordinated response, and you know, I think it's incredibly positive, and it's a bit of a wake-up call for the rest of the world. You know, we've all sat back and we've been happy to get cheap products. We've been happy to lose a lot of expertise within our own countries and let China in particular pick up the slack. But then there's been a penny dropping moment where the rest of the world's gone, oh, is that really in our best interests? We're exposed. What happens if different events play out, as we've seen most recently? So I think it's incredibly positive that we're seeing this coordinated approach to building increased resilience in global supply chains.
I'm going to keep you there, Andrew, keep you on the hook. I should explain that we were due to have a fifth member join us, Joel Turco, who is the voice of Wyloo Metals here in Western Australia. Unfortunately, being the voice of Wyloo, he's lost his voice with laryngitis this morning, so he was unable to join us. But that means Andrew, as the only other nickel-related company executive here on the panel, I'm going to throw a couple of his questions your way. And it's related to that very issue of, and the KMP in particular, you've come to agreement with EFA and USXIM. There's a whole host of opportunities, and Michael mentioned the differing agencies and funding and grants available. How do you assess where you go and what the company does? Does Ardea just take the first thing that's on offer, or is there a way of being able to assess what's best for the company and its shareholders as against project development and what's on offer?
Yeah, we try and assess all options available to us, and we have to be conscious of, well, what's in Ardea's best interests, but then, you know, manage the governance requirements and relationship with our joint venture partners. So historically, you know, Ardea held 100% of the Kalgoorlie nickel project. Now our Japanese partners have earned a 35% interest in KMPL. So, you know, there's some things we can manage on our own, but there's certainly other aspects, you know, where we've got to consult with our partners, because there's 4 companies involved in the Goongarrie Hub. Obviously KMPL, the joint venture vehicle, Sumitomo Metal Mining, Mitsubishi Corporation and Ardea. So there's not a one size fits all, but yeah, we put a lot of time and effort into our future funding strategy, because our greatest challenge, as I've touched upon, it's that the nickel market sentiment has such a bearing on our share price, and we can't influence that nickel sentiment at all. So we have to continue what options are available and where we see those being in Ardea's best interests, but also considering longer term, well, what's in the best interests of the Goongarrie Hub, our most advanced project.
Thanks, Andrew. Luke, I want to come back to you, and a phrase actually Andrew just used there, one size fits all, because in this name of this conference, we collect a basket of materials that covers a lot. You know, the nickel market, which is deep and wide, and its uses are quite wide, and stainless steel obviously being a primary driver of that sector, is very different to rare earths, which is again very different to lithium, which is again very different to, what were some of the other commodities we heard today? Washi, gallium, rubidium, and a whole host of others that I can't always pronounce. It's not a one-size-fits-all situation, is it, for either market or national interest?
No, and I think that's quite a key point, is targeting the right points in the supply chain. It's almost, governments shouldn't be picking commodities that they think are hot, it's picking points in the supply chain that are either tight or achievable. So like the Alcoa Gallium deal, it kind of works because it's something that you can action at relatively low capex, and you've made a difference. It's tackling grander challenges is more tricky, it's more expensive. So it's quite good to pick points in a supply chain that maybe are slightly either small supply chains, but have a large downstream interest, whether that's defense. Again, we talk about small tonnages, but value in use, you've got to try to think about how that looks. Value in use could be a very small thing in a chip, but the whole thing doesn't run if it's not got it. So I think trying to identify points in a supply chain that are hyper-targeted, I think, is probably the key, especially maybe for governments, maybe like the UK, that are slightly, let's say, shallower pockets, that maybe that's a way that you can, have real impact in the sort of specialty sector. And that's what the UK have done very well in the past. They had less common metals and all of these guys that are hyper specialized in a really small part of the market, but actually that part is very important. So I think that's where governments can really make big impacts, is supporting the hyper specializations and not trying to tackle a grand challenge, because I think that's maybe too optimistic.
Jennifer, Luke is right in very many ways, and I suppose when it comes to it, criticality is in the eye of the beholder, isn't it? That the UK, what's critical to the UK may not be what's critical to the US or to Australia.
Absolutely. We've all produced lists of our critical minerals, and they don't entirely overlap. And that brings me back to the importance of the demand aggregation, which we're doing not only in our Department of Trade, but also in our Ministry of Defence. So we have a new National Armaments Directorate, and as you were saying, a philosophy of very much targeted what is going to be the critical warfighting capabilities and how do we get after them.
Michael, I mean, you mentioned the greater interaction between departments. And Luke and Jennifer, right, what is a big financial market or off-take market for lithium does not necessarily apply to the defence requirements that make gallium or rubidium a critical mineral. Yeah, well, I mean, if we're talking about sort of, your question is about what the ultimate demand for some of these products are. Yeah, this is another big challenge, maybe the biggest challenge. And I had mentioned in my remarks earlier when Secretary Rubio convened the conference earlier this year, on the sidelines of that conference, there was a related business conference or a public-private partnership conference. And a lot of those discussions were about how to create a more consolidated and efficient marketplace for a lot of these items, because I think, as Jennifer mentioned, there can be ups and downs in terms of demand cycles, especially when it comes to defense, which I think is probably the largest market for many of these materials. But then if you bring together the largest users of some of the materials in a group, I think that provides a lot of the certainty that we need to see. And in my mind, there's a huge opportunity looking forward as we see the AI and the quantum space just explode. But it's a matter of making sure that to the extent that we can control these things, that these companies are good, I would say, corporate citizens, I suppose, and ensuring that they're not undercutting one another and undercutting the efforts of our governments in doing that.
Yeah, Luke. Yeah, I think one thing that's interesting about the whole taking stock thing is the markets that people have not quite realised until it's almost a bit too late. There was a lot of rumours going around in the US, and there was concerns from that side about yttrium coating for turbine blades on aeroplanes, and there was sort of things going around saying we've only got a few weeks' supply, and this could ground planes by Thanksgiving, and that was a big concern. And I think people are, governments are now properly taking stock of what is important, and maybe, yttrium was caught up in the wider rare earth story, but it was, commercial as well as defence. So I think it's just trying to make sure that, we are tying up all of these small parts, because you talk to a Rolls-Royce and they basically use everything on the periodic table. That, a lot of those things, 99%, haven't been a concern forever, so it's kind of just taken for granted. And now it's not taken for granted as such. It's, really making sure that, we're taking stock across all industries. And as you say, I think demand and, industry need to be really clear on what they need. I think that's really important.
Is that a greater challenge in those niche, exotic minerals that really we've never seen a commercial dedicated mine for gallium? And I know this is something you mentioned earlier, Michael, or yttrium, there's not a dedicated mine and the quantities required each year just don't match with the commercial proposition of a mining project.
Yes. So it goes down to that whole thing of, what do you value of security of supply and what is value in use? And I think that's probably where pricing is going to slightly move to, will be value in use, but then everyone has to remember that gets passed on to the consumer fundamentally. They're never going to, the airlines aren't going to take that on their books. That's going to be passed downstream into the consumer. So I suppose, government, industry all need to work out where this pricing lies for, value in use, security of supply, what value, what cost you assign to that, and how that looks in terms of consumers. And I suppose as prices go up, you've got the risk of things like thrifting and innovations as well. So magnets are a great example. If the NdFeB price goes through the roof, people start looking at iron ferrite and things and actually reducing that. And then you've got demand destruction. So it's quite a fine balance between price and demand.
Jennifer, this is where the UK's new strategy around recycling is obviously a major area that if you can't build a commercial mine off the back of one niche commodity by recycling and winning it back in those processes, it becomes very critical to those industries.
Absolutely. So that's why our approach is not simply about diversifying the supply chain. It's rather more complex. And so when we have the aggregated demand, then identifying the best path through that. But there are good opportunities now that we want to look at,
Andrew, have you looked in the KMP? Is there any opportunity for even further niche materials to become byproducts other than the cobalt, of course?
It's a really good question, Dominic. It's something we put a lot of time and effort into as part of our research and development focus. So as part of the definitive feasibility study, we'll have expect a material scandium resource. And we've always known that scandium is in the nickel laterite profile. But historically, given the age of the Kalgoorlie nickel project, when exploration first started about 22 years ago, you couldn't assay for scandium. So whilst we know it's there, we don't have complete coverage in all of the historical drilling, but we will have we do expect a material increase in the scandium resource, which could potentially be a future byproduct credit. And with our partners, we've left space for a future scandium refinery in the process plant layout. And then similarly, we've got occurrences of other critical minerals like gallium and some of the rare earths. And we're considering options there. It's both within the Goongarry hub, but more broadly within the Kelpini hub, where Ardea still has 100% control. And we'll keep working with our partners on when's the right time to look at some of these other opportunities as well. But it's a really good question. A lot of it comes back to demand and pricing.
And that's before you solve the metallurgical issues of trying to create a product. Well, we've still got a bit of time left, and I've been very greedy this week and asked most of the questions. I think I should open it up to the floor. Did we have any questions or comments? One straight away. Sam, just over here. If you could just let us know who you are and who you're representing, that would be great.
Sorry, just bear with me. I want to talk about rare earths in particular. Very recently, a list was published of all of the letters of intent, loans, guarantees, etc., that various US government departments have provided to support rare earth projects. The Rare Earth Observer, which I'm sure you're keen reader of Luke. But they added it all up and it came to about $8.9 billion US for rare earths. This is what they have to say. Top bureaucrats and politicians are generalists. They have to be. If they weren't, they wouldn't be able to do their jobs. Basically, they have absolutely no idea what they are doing in rare earths because it is just so fabulously complicated. However, they also don't question their often simplistic assumptions. Raises a really important political question, I think, as to whether or not governments should be making the decisions about how to invest, where to invest, etc., etc. And the point you make, Luke, about getting in at the right point on the supply chain rather than just throwing money at a project. And I'd like your thoughts on whether or not governments really should be stepping back. Okay, sign the letter of intent, sign the MOU, but leave the due diligence, leave the evaluation to experts in the field. You avoid pork barreling, you avoid public criticism, and I think one example which I think is quite relevant is the way in which Macron invested 500 million euros in the Critical Metals Fund. He took the money away from Treasury, he gave it to Infravia, an infrastructure institution, private, etc. They made the decisions. It took them nearly 3 years to decide how to spend the first 50 million, which I understand Tim Buckley wasn't impressed about. But, you know, again, a smart move, because it stops people complaining that, you know, this project only went here because this Republican congressman's about to lose his seat, etc., etc.
Yeah, so we work both with the US government and Infravia, so we've got perspectives on both. And I think from a US government angle, a lot of the focus and a lot of the people you speak to are State Department, maybe ex-China analysts and things like that. So I think the strategic impetus is understood of what these markets mean and where the concentration of the markets are. I think, as you say, the technical side of that is a gap that is being filled. I would say, if you'd asked me this question maybe November last year, where all those LOIs went out, I would have said that was a bit of a scattergun approach. But I suppose when you've got deep enough pockets, you can afford a scattergun approach initially. And I suppose that needs to then get refined later on. And I suppose these letters of intent are letters of intent as such. So, and the MOUs, an MOU is not always worth the paper it's written on. So that's something to remember, that this isn't, a lot of it isn't binding. And I suppose they've put out the signals now of what they're hoping to do, and hopefully some technical refinement comes from that. And I think you've seen more focused deals since there. So I think, yeah, if you'd asked me November, I'd have said it was probably slightly, maybe a bit of an overshoot in terms of the amount and the breadth of projects that were being supported. But now I think that they're in the stage of maybe taking audit a little bit and working out, okay, where do we sit in the supply chain? And yeah, they're getting advice on that. And yeah, as you say, Infravia taking things from a different approach, I suppose, far more cautious with the funds. They're being more careful, but then I suppose caution sometimes means slower progress. So I suppose it depends on how you can justify taxpayer funds, and in terms of potential wastages or risks, I suppose it depends on how much risk you can put on a taxpayer fund, and that's probably, that probably opens up the differences. I'm not sure if you want to speak to it.
Sure. No, I think that partially, if I'm being frank, it sort of, the quote represents a misunderstanding of how the US government operates. I'm a career civil servant, and there's a good reason that Mike Clausen is not in the interagency discussion making these decisions. I simply don't have the background or the expertise. If I have any sort of expertise, it's geographically focused, Asia, Europe, and not in a particular subject matter. However, this administration and previous administrations is constantly bringing in the expertise it needs or it believes it needs to make these decisions. So a lot of the folks that are involved in these discussions in Washington, whether that's at the Department of War, the Department of Energy, the Department of Commerce, the White House, and any of the sub-offices within those organizations, they just stepped out of the boardroom and put on a suit and are now working for the US government on a temporary basis. So they have the types of expertise needed to make these decisions. And I know that everyone has an opinion about the projects that are selected, and that's fair. It should be a marketplace of opinions, and people are going to disagree. But ultimately, I do think that there is some due diligence. I know that there's a lot of due diligence is being conducted when these projects are selected. It's not a scattershot approach. To the extent that we want to view it as a scattershot approach, I would suggest that perhaps a better phrasing would be a venture capital-like approach, where you're going to fund 10 projects with the idea that 7 are going to fail, 2 might break even or turn a small profit, and 1 of them is going to make you $1 trillion.
I suppose that's one thing to point out. Yeah, as you say, that approach of funding multiple projects and picking a national champion, that's all that happened in China 20 years ago in terms of the battery industry. So wide, I suppose if you've got the funds for it, that wide approach and then picking a national champion, that kind of works in my opinion. But yeah, Thomas at the Rare Earth Observer is notoriously pessimistic. So the biggest compliment we've ever had from him is that we are reasonable. And that's, that was the brightest compliment we ever got. So he's notoriously pessimistic, but yeah, very knowledgeable on the industry.
We've got another question here from Tim.
Thanks. Luke, maybe the framing you mentioned about ultimately the value in use, I totally agree with you. You then went on to say, but we've got to be aware of the cost to consumer. Where I'd reframe it is that if you think about the military value of these tiny but critically important elements, the value in use is irrelevant to the American military or to any military. I got involved in critical minerals 15 years ago when I read a US Department of Defense paper to Congress highlighting the strategic critical risk for America's military because of China's concentration of control. It's only in 2026 that the American government's finally addressing the strategic threat. So ultimately, diversity of supply chains is really valuable, as you're saying, but value in use, I agree, a lot of the stuff is for industrial use, and hence, as you mentioned, Rolls-Royce or whatever, they've got to pass that on to consumers, but military, so I think we've got to be really careful about that. China's got America by supply chain. Well, yeah, exactly. Thank you. Supply chain because of that critical military value. And so America needs to diversify as it is only entirely strategically sensible. So, sorry, more a statement than a question, but value and use is, this is a small product, high value, and we've got to realise diversity of supply chain is key.
Yeah, I think that probably the only thing that I would slightly push back on that is tonnages. If you're talking about tonnages, unless you're selling it to the military at one price and selling it to consumers at a lower price, then in terms of actual mass tonnages that are moving in the market, most of that is consumer goods for most markets. I don't know, samarium, cobalt, magnets, probably maybe you've got slightly more military weighting, but a lot of that in terms of a weighted average cost of where that's going is going to consumers. So I suppose unless you've got maybe, a small offtake that's going at a premium price to military to secure that material, and then the rest is going to mass market and market pricing, then, there's a slight awkwardness around there in terms of, where tonnages of material are flowing, from our opinion.
Thank you, Tim. Have we got another question, comment? We've got one from our esteemed session chair.
I just wanted to go back, something Tim said, and I think Andrew mentioned as well, the comments around gas and more specifically affordable energy. So to go to the gentleman's point over here about bureaucrats not potentially understanding new industries, it's new issues with old industries as well. There's some refineries in this state that have ticked along nicely for 30 years. It was staring down the barrel of a 5-year bridging period but between affordable energy, non-affordable traditional energy, and then a period down the track where renewable energy might get to a point that it's back somewhere in the sustainable range. So I'm mindful with Andrew building a high-pressure acid leach plant out in the goldfields. One of your slides indicated the gas pipeline was nearby. Obviously, having secure and affordable supply of gas and energy in this state, if we have any hope of what you said, Tim, around Indonesia insisting on people coming here and downstream processing to some degree in exchange for having access to our minerals.
It's a terrific point, and obviously cost-effective power is just a huge enabler, and that's part of the reason that Australia is currently such a high-cost jurisdiction to do business in, particularly for further downstream applications. A lot of our power is going to come from byproduct steam, so we need a sulfuric acid plant on site. So sulphur is going to be our highest cost consumable. We'll burn the sulphur on site to produce sulfuric acid for the process, but the byproduct steam will help drive turbines and produce some of our power, and the whole power balance is a key part of the in-progress definitive feasibility study, but it's looking increasingly likely that we'll also need to tap into the gas pipeline. And we've had lots of media coverage and industry news about the increasing cost of power in Australia, and I'd love to see a more coordinated approach from every level of government and industry. We're blessed, particularly here in Western Australia, we get more hours of sunlight than just about anywhere in the world. The wind blows most of the time. Yes, we can incorporate renewables, but we've got the oil, we've got the gas and the hydrocarbons, the coal. We've got some of the largest uranium resources in the world. My personal view is we have to keep working together to drive down our energy costs. If we want to be cost competitive as a nation, we just have to do more with energy security. As I mentioned, we're blessed, we're in a great position to start, but as you rightly pointed out, the recent increases in power cost are adversely impacting every industry in Australia, and we need to do more to drive those costs down. It's a key point because it's one of, if not the most important enablers for industry to succeed.
Jennifer, it's been a similar debate in Britain as well, hasn't there, around economic zones and being able to encourage that midstream or downstream processing. I'm thinking Teesside, where that was announced as one of the first special, I don't know, you might know the phrase, special economic zones for lithium refineries.
Absolutely, and so Tees Valley Lithium is hoping to set up a refining plant that's going into production next year with Chilean feedstock. It's complex, and that's why that slide that I put up about the potential support to critical and growth minerals is not limited to specific critical mineral support, but also our wider growth fund, a fund supporting electronic vehicles. It's all part of the national renewal.
Michael, the discussion, Luke's pulled himself back a couple of times from saying money is no object in the US, but is this a discussion that comes into that critical minerals processing debate around, how to keep prices low, how to ensure that the industry is competitive in a commercial sense as well as a geopolitical and strategic sense?
Sure. I mean, at the end of the day, budgets are driving everything, right? Everywhere around the world, both in the private sector and in the public sector. I think it's obvious that the United States has deep pockets, but we also want to be responsible stewards of taxpayer money and ensure that we're not just throwing these after projects that don't have any sort of commercial viability. So those discussions are constantly happening, and I think that there's no shortage of focus on this idea that that funds are not limitless and they need to be deployed in strategic ways. We'll continue to do that, but to Luke's point, I think that we're still at a point now where we don't know quite what the future is going to bring. And so rather than expenditures, I would argue that these are very large investments for right now. Some of them will have better ROIs than others, but I don't think that there's any intent to just throw bad money after good.
And we're seeing individual states such as Louisiana and California trying to attract downstream processing through third-party feed or international feed. Thank you. Right, we haven't really got one more time. We've got half a minute if we've got any burning questions. No, I think we've satisfied everybody. Well, we're only due for 45 minutes. The clock started at 50, so we're over time. So if you could just join me in thanking each of our panelists, Jennifer, Luke, Andrew, and Mike. Thank you very much. And now we can pass back over to Michael for the final couple of presentations of the session. Thank you, Michael.
Thanks, Dom. Two more speakers in this session, so I'd like to welcome Dianmin Chen to the stage, and also Richard Maddocks, if he's in the room or hovering out near his booth. He might like to come and join us. But first up is Dianmin, a mining engineer with more than 35 years' experience in metal mining. He has a wide range of roles in the mining industry, including technical, production, management positions in Australia, China and Canada. Dianmin has held previous senior management and executive roles, including with Barrick Gold, Sino Gold, CITIC Pacific Mining, CA Nickel and Norton Goldfields. He has also served as a non-executive director for several listed companies in Australia and Canada. And he's also had a very good announcement hit the market this morning, which I'm sure he's about to tell us about.
Thanks very much, Michael, for your introduction. I'd just like to share a story of global lithium. So we would like to show you how we're going to become the next lithium producer in Australia. So Michael, so that's just press this button to go forward. You got it. This is the one. You got an issue.
There we go. The big green one.
Ah, the big one. Okay. All right, just a formality, disclaimer. Just a snapshot on our project. The Mana project is our flagship project, 51.6 million tons of resource at 1% lithium oxide. It's a very good location strategically. So just 100 kilometers east of Kalgoorlie, in the middle of nowhere, but it's close enough to Kalgoorlie, which is the most important mining town in Australia. Robust DFS were finished end of last year. So in that area, we have a significant mining companies in the area, including Northern Star and Evolution. You can name the rest of the major companies in Australia. Experienced board, team, including myself, and we know how to build the mine and then put it into production and make money. Supportive offtake, and as Michael indicated, we just signed the offtake agreement with one of the major downstream processing in the world. So there's a local technology who operating in China and Indonesia as well. So $75 million will be in the pocket. It's very nice to be. So we also have an offtake agreement with Chemex, which is the biggest lithium chemical producer in the world. They are producing 170,000 tons lithium carbonate and lithium hydroxide every year. So we've got 70% committed. We are now rocking on the road. That's our team and then share structures. So still we tightly held shares, 263 million shares on issue. So the biggest shareholder, including Minerals, which is the major lithium producer in Australia, and also the iron ore producer as well. Chemex, so now we've got another one possibly in the next couple of weeks. Local will be on our register. So very nice register in terms of the downstream from the mining, lithium chemical processing, and the material producing. That's Lopo is the second largest cathode producer in the world. They are producing just over 1 million tons a year. Just lithium outlook, I'm pretty sure you're in this room, you know there will be tight in supply. I have been in China 3 times this year alone, so I can see the growth in demand in China. They are way, you can see the price increase in the last few months. We just accept a visitors group yesterday from China, the Analyst, and they think in the next few years they will remain tight in supply. That gives us a good chance to really to get the production ready and start making some money. So, Mana project. So it's a very exciting project. So we got that Western Australia would be the best mining jurisdiction in the world. As I said in other occasions, we got our mining lease in 3 days after submission. It is a tick for David Michael, who presented yesterday here. Certainly, the government is supportive in mining and a good jurisdiction for the mining industry. So it's a very good mine operating in the area. We got all the different supplies and technical support in the region, which is going to be a good for a new company like us into production. We might be able to get some technical person and support from them as well. Good luck on us. Established a supply as well. So I think the logistic-wise and supply-wise, we are only 1 hour away from Kalgoorlie, and certainly it's going to give us a good chance to really get the support we want when we build a new mine. So we got a very good, we are in the next production mine in Australia, so we'll be well supported in nearly all the possible requirements we require to build our new mine. So, Mana project, we have drilled more than 110,000 meters into the ground, and our chief geologist, the geology general manager for geology in the audience, and he is from the day 1 to manage the exploration program for us. We're very confident on the resource we got, 51.6 million tons, and more than 60% in the indicated. We got about 19.4 million tons in the reserve. So very robust resource model. We're very confident we can go into the FID, possibly late in the year. So that's our DFS snapshot. Really $440 million pre-production capital required to build the project, $472 million MPV at a discount 8%. I'm pretty sure when you read our announcement, we're not require 8% because our interest rate will be paid is only 5%. So $1.15 billion free cash flow from the project, which is going to have 25.7% IRR. Very quick payback, even with the price of $1,400 US dollars per ton SC6, it's going to give us 3.5 years. I will show you on the other slides and how fast we could pay back. And non-life, 14.3 years mine life, and break-even cost is about I think it's about $750 US dollars a ton. So our FOB cost is $646 a ton to the port. So very robust project, long life, and certainly it's going to be well supported by the investors, and it has been evidenced by today's announcement. So that's basically the technical page. So 1.8 million tons a year raw feed. We are going to use all sorts to remove the waste, to reduce the mill feed to 1.5 million tons a year. We're going to produce 236,000 tons of lithium spodumene concentrate a year. Grade is 5.5. So SC 5.5 cost it's 646, which is very competitive. Oh, just go back to the one, and that must be the smaller one. Go back to one page.
The red one, yep.
Okay, just show you the more technical. 3-stage crushing, very conventional. One ball mill, gas-fired power. So we're going to use Dianmin, magnetic separation, and a microfloat to produce a very high-quality concentrate. And also the important, we are going to have a dry stacking tailings. We're not going to build a tailings dam. So, and we're waiting for the environmental department to give us an okay. So we signed an MOU with the Southern Port. So we're going to exporting our product from Esperance Port, and we're very lucky to have that kind of arrangement with the Southern Port because it's a lot of space at this stage. Just to show you how we could do better, today's price is $2,500. If that price is applied for the next few years, and then, so we would only need 1 year to pay back. So that will show you the upside from our project, very good share to invest. That's the road to what's the upside we're going to have. So we are very conservative to design the to do the DFS. We only scheduled 72.8% recovery, which is conservative from our major shareholders like Chemex. They think they can help us to get 80%. Mining costs, we certainly will have other options. We are actively engaged with the equipment suppliers. The indication from them would have a much better than what we have planned. They have low interest loan to us, possibly to have equipment ready for us in the if we make a decision, and it should be running on the side in 5 to 7 months. Infrastructure, as I said, and we are working with other suppliers to see we can use some other facilities like solar and energy storage to further reduce our cost. Certainly, we are working on the automation and to effectively manage our production and so to reduce cost further. So approval, we're lucky, as I said, we're lucky in Western Australia. The process for approval is straightforward. So we have signed in the last, we had a very exciting 12 months, and then we signed the native title agreement in August last year. As I said, it's only a few days after the mining agreement, we got the 21-year mining lease. So we're in the final stage of environmental approval. We submit all the documentation in March. We hope we can get all the approval in the next 2 to 3 months. Miscellaneous license, I think we got most of them. We're ready to run on the ground soon. that's just a schedule to show us, show all of you. And so we're going to have a FID late in the year, and possibly we'll go quicker based on today's announcement. So that's the biggest hurdle for us to jump over is the funding. So we've got $75 million in the tin, and we are negotiating with other parties to have more. We are engaging with the investment banking for them to raise some more capital for us. We expect in the next 2-3 months, all this will be in place for us to do the FID. So we expect possibly to bring the FID slightly earlier. In terms of construction, about 70 months construction time, which will enable us to start to produce the concentrate in the first quarter in 2028. We targeted to have the first shipment of concentrate in the second quarter of 2028. That's basically our mini story. Just catch up, and we're very sensitive on the community relations. So we have been, that's why we did very well. We signed the native title agreement very quickly. So we still maintain a good relationship with our community. We had 2 community relation committee meetings already, where this is going to pave the way when we operate in their ground. So why invest in global lithium? One of Australia's major undeveloped lithium project. So tier 1 mining jurisdiction in Western Australia. MPV, if we use today's price, would be more than $1 billion. So expecting to the FID possibly, if it's not in the 3rd quarter, it must be in the 4th quarter. Given today's announcement, we could bring a quicker. Funding strategy, as I said, we're very flexible. That's why we signed an off-take agreement. We're negotiating with the investment banking for equity, and we're also negotiating with somebody else for other financial options. So our team is very geared up. We wants to be the next lithium producer in Australia. So we really would like to get the team running on the ground by the end of this year. So that's very much our story. Hopefully, we can tell you more in the coming months. All right, back to you, Mike.
Thanks, Dan. Well done. Thanks, Dianmin. If I could welcome Richard Maddocks to the stage. Richard is Managing Director of Kingsland Minerals. He's a geologist and has extensive experience in development and production in open pit and underground gold and nickel mines in Australia, Papua New Guinea and South America. He's previously been Chief Geologist at several large open pit and underground gold and nickel mines in WA, and Mr Maddocks has significant experience in mineral resource estimation, grade control, exploration, business development and asset identification. Thanks.
Great, thanks very much for that, and thanks for being here to listen to the Kingsland Minerals story. Yes, the big green button it is. Good. There's the disclaimer here. We're a listed company, so that's all of our appropriate information there. Look, I'll go through the talk today and talk about the Kingsland story and what we've got here. We have one of the largest graphite deposits in Australia, or one of the largest in the world, up in the Northern Territory. So I'll go through some of the details there and just let you know where it is. I'll let you know what we've got there as well. And also our plan, or what we've done to date to develop it to where it is now, and also our plans going forward in the future to develop this fantastic project. So here's our location here. We're about 2.5 hours drive south of Darwin, near Pine Creek. Pine Creek is an historic gold mining area there, so the local community is well and truly up to speed with how mining operations work in the community there. We're very close to existing highways and infrastructure. You can see there we're close to the main infrastructure corridor going up into Darwin, so we're very close to sealed highways, gas pipelines, railway lines, high voltage power lines, and there's a gas turbine power station at Pine Creek as well, within about 30 kilometres of the proposed mine site there. So it's very important to realise that the location there is, infrastructure's already in place. We're close to the port of Darwin. We're close to export facilities there in Darwin to export our flake graphite concentrate to Asian markets and beyond. So it's a very fortuitous place to do this project. What we've got there, it's the Allum graphite deposit. I think we announced the discovery of this about 3 years ago. It's on a contact zone between a granite intrusive and some sediments, where the granite intrusive has cooked up the carbon in the sediments into graphite. So we've got this nice long zone adjacent to the granite contact there, full of this graphitic schist, which averages around 7 to 8% total graphitic content, TGC. We've only drilled a small part of that. Obviously with 15 or so kilometres of strike length, there's a fair bit of drilling to drill that out. So we've targeted a very small area first, just to prove up the concept that we can get a resource on this and we can potentially develop this project. So we've got a resource here of around 190 million tonnes at 7.3% TGC, and that's contained within a broader exploration target of between 700 to 1.1 billion tonnes, between 7 and 8%. So even though that current resource here of 195 million tonnes is one of the biggest in Australia and indeed top 10 in the world, we think, the potential there is to make it significantly bigger if we do some more exploration along strike there. So it is a big deposit with potential of a multi-decade mine life. There's a close-up there of the drilling we've completed to date. That's about 2.5 years' worth of work there for that drilling there. Again, it's up in the Northern Territory, so drilling is limited to about 6 months per year with the monsoon, the wet season, and that mainly affects access to the site with creeks flooding. So once we develop the project, we aim to get access there 12 months a year with access over those creeks with improved culverts and bridges. But the drilling now, you can see there, it's broad intersections of high-grade graphite there. It's outcrops on surface. You can see that western side to the left-hand side of the screen there. It's continuous, it outcrops. It's nice, a nice deposit there. It's in a good location there as far as open pit mining geometries go. You can see there's a section there in that green box. I'll show you that next, but that green box there is where we've focused our scoping study, which we released last year. We did some infill drilling there to upgrade part of the resource to indicated to do a proof of concept study for the scoping study, which I'll go through in detail in a little while. But that section there in that green box there is a typical section through the ore body. You can see it's, like I said, outcropping on surface. It's about 140 metres wide, or up to 140 metres wide. There are fairly continuous higher grade zones within that, obviously, so a mine plan going forward can target higher grades here of 10% plus. So it's a good ore body for open pit mining, and that's what makes this a fairly compelling project, as I'll explain in the scoping study, that the geometry of the ore body there and the fact that outcrops leads to fairly competitive mining costs. The metallurgical test work to date we've done, it's been fairly preliminary to date. What we've done is we've taken about 100 kilograms of sample from the drilling we've completed. We've put that through a flotation circuit here at IMO in Perth as our metallurgical consultants. We've produced a graphite concentrate averaging about 92-93% total graphitic content, TGC. So we've proven that we can produce a saleable product with the graphite concentrate there, and we can get decent recoveries. The recoveries are up around 90% as well. So, all those characteristics and parameters are pointing towards a economically viable deposit. Our plan at this stage, you can see in those two boxes there, stage 1 and stage 2. We're focusing on stage 1 here at Kingsland, and that is producing a graphite concentrate on site. The plan is to truck that up to Darwin, and from Darwin we can, the stage 2 is to either process it at Darwin with a downstream processing facility to produce purified spherical graphite, and also to possibly export flake material to other downstream processing facilities, probably in the Southeast Asian region, given our location here at Darwin, very close to Japan, Korea, Indonesia, China, those sort of places. So it's in a good position there for us to export those graphite concentrates. We've also done some downstream test work as well, just to assess the viability of producing the purified spherical graphite. We sent a sample of concentrate off to Germany. Pro Graphite, Germany, company in Germany, does this sort of work. They managed to produce a purified spherical graphite of up to 99.97% grade, which is above what you need for battery anode use. The electrical properties too were suitable for battery use as well. Again, this was just our first test and we got those results. We were very encouraged by that. We can produce those high grades without using hydrofluoric acid, again, which gives you confidence that we can process these sort of things downstream in jurisdictions like Australia. So it's very positive, and it, obviously that encourages us to do a lot more work on this metallurgical test work to assess the, well, not to assess, to prove up the economic viability of this project. Now, the scoping study we released in September last year, it's worth pointing out now that the scoping study was based on a fairly small part of that total resource. We drilled out around 10 million tonnes of indicated resource, and that was the basis for the scoping study. So the scoping study doesn't fully reflect the potential of the mine life of the project. It was really there to have a proof of concept that we can produce concentrate at a competitive price and get that ready for transport up to Darwin. So you can see there that that's the, our initial site layout there, that small open cut there. Again, that's, again, to emphasise that little red open cut there will get a lot longer and a lot bigger than that. That open cut targeted about 100 metres of the top part of the ore body, so I would suggest that the ore body, the initial pit will be a relatively shallow pit. The strip ratio of that was less than 1 to 1, it was about 0.8. So, you know, we only mine 0.8 of a tonne of waste to mine 1 tonne of ore, so that reflects what ends up being very, very competitive in our mining costs, you know, open cut mining costs. The processing plant we used for the scoping study was 1.5 million tonnes per annum. And again, with a larger pit, you could imagine a larger processing plant potentially, and that optimises the processing cost on a per tonne basis, so we could lower the costs as well. And we also used mains power for this. Now, given we're only about 25 or 30 kilometres from a gas pipeline, with a longer mine life, you'd obviously look at having you know, gas turbines generating your own power on site, which would be a considerable saving to the mains power. And obviously too, you'd look at some renewable energy options as well to reduce the power further. So we're pretty confident going forward when we develop this into a PFS, which we've started doing now, that we can optimise this scoping study and lower our operating costs, you know, mining costs and processing costs, and come up with a project which is pretty competitive on the global stage. So that's some of the initial figures there. Again, the mine life there, 7 years. That obviously is not long enough to push the button to start construction on this, but our next step is to do a lot more drilling to increase the indicated resource, and we hope to put some larger numbers in front of that 7. I think it's multi-decade mine life is fairly obvious from the resource we've got. We just need to upgrade that inferred resource to indicated, and we can start putting some more meat on the PFS. The initial capital cost there was for a 1.5 million tonne per annum mill and all the associated flotation circuit that goes with that, and the construction and the accommodation camp and power. We have to build about a 20 kilometre power line in this scoping study, things like that. So you can see there that the capital costs aren't too onerous, and once we get that mine life going out, it'll improve the economics significantly. So that's our operating costs there in US dollars, $423 per tonne of concentrate produced. And you can see how that sits in with the world figures there. You can see there at the moment we're very competitive compared to ex-China operations. And as I suggested before, once we optimise the mill size, optimise our power supply, and also the mining and things like that, we're fairly confident we can reduce that and be very competitive on the global stage. Should we use a flake graphite concentrate to use for battery anode material. Again, that's a snapshot there of the inferred resource and the exploration target in I guess, red. It looks red to you, yeah. You can see there that the pit's only a very small part of that total resource. Again, just to emphasise that the scoping study we put out is a snapshot of a very small part of the overall picture there. And we aim now to do a lot more drilling on that inferred resource there, which is in the grey there. And also we can extend that to the north with the exploration target there and do some more drilling there and get a significantly larger resource than our current 190 odd million tonnes. So we're pretty confident we'll get, like I said, a multi-decade mine life and then one of the biggest graphite resources in the world. So what we're doing now, like I said, increased drilling there, more metallurgical test work, which we're doing now, and I'll discuss that in a second with some of our byproducts there. We've already applied for our mining lease, and we're starting to do all the work for that with the heritage and native title negotiations there. And in that last point there, we've also noticed we have got byproducts of rutile and gallium. Not particularly high grade in their own right. I mean, it's byproduct there. Since we're crushing, grinding and floating, we're looking at if we can get gallium and rutile out of it. We've done more test work on the gallium than anything else, and we had a release a couple of weeks ago which showed that we can leach gallium out of this material. So it is readable, leachable into a solution, and from there it's the next step is to precipitate a gallium compound. So we're assessing, well, we're doing more test work now. The next stage, and if you come to our booth just outside the door there, we've got a sample of rock there, and the rock's got quite a lot of mica in it, and the mica is where the gallium is. So we're doing some flotation tests soon to float the mica. The work done to date has obviously been focused on floating graphite, and the grind size and things like that have been optimised for graphite. So we'll do the work now for mica. We'll float the mica, and then we'll do some more leach test work on that to assess the economics of leaching a gallium solution out of that mica. So what we've done to date there, we've got an indicated mineral resource which needs to be bigger. We've proved that we have got a marketable concentrate there. We can produce a marketable concentrate of around 94% TGC. We've got a offtake agreement signed with Quimbrook Infrastructure Partners. Now, Quimbrook is a very large private equity fund who invests in renewable energy infrastructure in the UK, USA and Australia. They're on our register, and that's part of that stage 1, stage 2 plan I mentioned before. We produce the graphite concentrate, truck it up to Darwin, and then Quimbrook the plan is to potentially build a facility in Darwin to process that into purified spherical graphite. So we're working with Quimbrook to assess that. We've provided Quimbrook with a sample of material for their own purposes for test work. So they've already started the test work regime to produce purified spherical graphite, and hopefully we'll get results from that sometime later this year, and that'll set the ball rolling for that facility in Darwin as well. There's more metallurgy coming up there, more test work with the gallium and the rutile. They've got potential to be valuable byproducts, which obviously again contributes to lowering that operating cost to produce graphite. Scoping study is finished, PFS study has commenced. The gallium metallurgical test work is progressing, and so far it's positive. So going forward, there's our exploration targets for gallium and rutile. We're looking at producing a byproduct for both of those. The gallium is more advanced at this stage, and like I said, we can leach gallium out of the solid material. So we're looking forward to progressing that test work. Again, just before I finish up here, just to emphasise, we've got a fantastic large deposit in a great location, 2 hours drive south of the port of Darwin. We know we can produce concentrate. We know we can produce an end product, which is used in battery anode material. Early days yet. You can see there our market cap currently is around $7 million. We think we're significantly undervalued for the asset we've got, but we're going to do more work and hopefully increase that value. So I'm looking forward to updating everyone in the future on that. So if you've got any questions, our booth's outside the door there, so please come and say hello. So thanks for listening.
Thanks, Richard. That brings to a close a long but interesting session. Morning tea, I understand, has been served outside, and the next session recommences at midday. So thanks again.